Good morning, ladies and gentlemen. Well, we had a wonderful week. We picked the absolute top of the market. How did we close? Minus 55. Well, we are still ranging from, pretty bad to absolutely awful. Still in risk off, and the daily scores, as you can see here, from the beginning of the week, started off at minus 52, went a little bit better, and closed at the bottom of the week minus 55. Basically, just exactly as the market did, it closed at its absolute worst level. Um, Even in the weeklies, we can see that even though the score has slightly improved, the MA1 over MA2 is still going negative. So basically, the market is not yet in a position to mount a sustained rally that would take us anywhere more than the current range. I think we've established a range, and range is just that. They're ranges. You shouldn't force the top and you shouldn't force the bottom. If we now know what the top is, we should look and find out what the bottom might be. What are deviations telling us? Deviations are telling us that we still have a descending center line and that the jaws of the Bollingers and the standard deviations are coming in, basically telling us that we will range trade over the next several weeks. I think the absolute top has been found, and the absolute bottom will be either somewhere at this point, which is going to be probably 27.20, or at this point, which is going to be somewhere around the 26.50 area. But in any case, I'm looking for a period of relatively lower volatility than we've had in the past month and a bit on average. This level of the center, 275.20 and descending, is something that I feel that we will trade over the course of the next week, and where probably a small bounce can develop. When we trade, we should look for logic, and basically our logic here is as follows. Here we have XLY, XLK, XLV, and XLF. I think everyone probably would agree that without these sectors moving significantly, the S&P itself cannot move. Now, are any of them in a position to drive the market higher? No. I would say all of them have more or less shot their bolt. They have the same picture. They have the downward sloping still to various degrees center line. XLF being the weakest, as you can see here, it just can't get above it. And probably XLV being the strongest with the shallowest line. But none of these sectors are anywhere near to being able to carry the S&P, not even by themselves, and certainly not cumulatively. So we know that chances are, the overwhelming probability is that we have seen the top. 2955 is your top. Now it's only a question of trying to see where the bottom of the range is, because I certainly feel that the Fed is trying to lull the markets to sleep. How is the Fed trying to lull the markets? Well, I think it's basically through yield curve control. And yield curve control has started. Now, this is the 2s, 10s. I keep on telling you, don't look at the individual charts. Just look at the shape of the yield curve and what the yield curve is doing. And here it is, 1, 2, 3, 4, 5 days last week, trading between, what is that, 37 basis points and 44, 45 basis points. It's trying to lull the market to sleep through yield curve control. Yield curve control obviously is not an active Fed policy, but I think they are passively doing it. all they need to do is intervene in the various sectors, points on the yield curve at different times, just basically to ensure that nothing happens in the market. I keep on telling you, it breaks 35, yellow lights. It breaks this 30 level, red lights. I mean, every alarm in the world should be going off, because that is as as risk off as you can get in this market. While it's above 35 and in this range 35 to 52, 53, 54, basically nothing is going on. I'll put a line in here too, but this kind of level, to me, the 53 to 55 area is going to be very key. Above that area we have risk on, and below this area we have risk off. But I don't see the Fed allowing either. I think they are trying to lull the market to sleep by supporting different areas at different times, and the lower volatility in the bond market is actually going to lower volatility in the equities eventually. So the highest probability is that we have a range trade where we've established the top in the S&Ps, and now we will slowly, over the course of the next 2 or 3 weeks, establish the bottom. Well, they can lull us to sleep in more ways than one. And one thing that they have to do is basically now keep the differentials constant, because if the differentials are not constant, then the dollar starts going berserk. And if the dollar starts going berserk, eventually the equities will suffer and the bond market will no longer have low volatility. And this is exactly what they are achieving. I'm sure they are coordinating policy with the ECB, and now I think that they're trying to keep us between 125 and 100 basis points. 25 basis point range for the differential is nothing to write home about. Slowly, the moving averages from this move will catch up, and I think that we will establish basically a range between 100 and say 130, 135 basis points for this differential. And that is the way they're going to keep the yield curve control working, and the two stands, pretty flat. And Bob's your uncle. They will have achieved their aim. They will have basically, through jaw-boning and through action at particular times with their QE purchases, they will have smashed the MOVE index, the volatility index of bonds, and that will slowly have an effect on the equities. Here we have a weekly chart of the DXY and a daily chart. Well, you could say mission accomplished by the Fed. They are managing to keep the Dixie around this 98.50 area. To me, it's going to be very important that it holds this 98.33 area. 200-day moving average below the daily Bollingers, huge support at 98.33. You can see how it has been a swing level for such a long time, whether up or down. I really don't see it any lower than this. To me, this is the level that you buy some dollars and abandon the euro. I really cannot see them being able, look at all these moving averages here pointing up. 98.33 is a good risk reward level for longs in the dollar, and given what the differentials, the interest rate differentials are doing, and what the Fed's obvious aim is here, I think that is a decent level to be long of dollars. Gold also will suffer from the central bank puts which are being written here, simply because I keep on saying that 1667 is the very important level, and that it'll keep on trading at that level. Just like 2864 is important in equities, and it'll keep on trading there. 1667 to me is absolute key. It has, on a weekly basis, got to close above it to keep the momentum immediately bullish. But I can't see tremendous upside, simply because if the dollar remains strong above 98.33, and the interest rate differentials and the yield curve are flat, it is basically it's two forces pushing and pulling in different directions. You have the low yields, and you have the relatively strong dollar. That to me indicates that gold gets spinned around this level, its support, and really you are trading in a 5% range from that support towards the upper end, which makes perfect sense to me. This is going to take several weeks while these moving averages catch up, and then maybe we have another leg up. But for the next 2 or 3 weeks, I think the Fed and all the central banks are going to achieve their aim, which is basically to anchor the markets within a few percentage points of where we are. Right, having covered the dollar and gold and the interest rate differentials and the bonds, what is that going to do to risk? Well, I think the picture is fairly clear here. We touched the 0.618 retracement of the whole move. We got to 29.54.13 exactly spot on and backed off. Now you can see how all these moving averages on the weeklies are basically converging to one point. What is that one point? Well, here around 27.90. I think 27.90 is going to be very, very important next week, because if we break below it, we are definitely going down to the 27.20s, and that is going to be one level of support. But the much stronger level of support, I feel, is going to be this line, 26.75. I think that is going to be the bottom of your risk parameters at the moment. I know that people are excited. They wanted a much stronger move down, continuation. They're not going to get it. I think the Fed is going to achieve its aims. If you think about it, we just had Buffett come out. I was reading his speech and his answer to many questions at the Berkshire Hathaway yearly shareholder meeting, and basically said he hasn't deployed any money because he can't see anything to buy. Well, the reason why he can't see anything to buy is because the Fed is providing the liquidity that he would normally supply during a crisis, but he would supply it at much, much, much worse prices than the Fed is doing. If that is the case, why should equities go down a lot, right? I mean, it's not like the Fed has a finite amount of money. I mean, they can just keep on churning it out. And if they are providing it at better prices than Berkshire would, well, that means that the price of equities is going to be overall higher than it would otherwise be. So in trading, you have to go with the odds. The odds now tell me that the low of this range that we've established, while the top is 29.54, the bottom is going to be either here around the 27.90, or it's going to be at 27.28, or it's going to be at 26.75. At 26.75, you should be, prepared to be a bull for a 3, 4, 5% move up. I think it's as simple as that. What is the picture on a daily time frame? Well, not very different, is it? I mean, these Bollinger Bands are now contracting, which tells me that the market will have a range. The big support is right here. with these moving average around the 2780 area. And really the 2728 area is going to be very big support. I would be surprised if in the course of the next week we see the market much lower than 2728 or 2720. It is unlikely. I see absolutely no reason for it. The Fed is still there. We know what its policies are. Uh, the likelihood of people wanting to force the Fed's hand, it's just too early. It's not like the news is getting any worse. As time progresses, we are closer to a vaccine. We are closer to a cure. We are closer to reopening. So the news flow is gradually getting better rather than worse. So the fundamentals seem to be getting better rather than worse. I really don't see why the market would try to force the Fed's hand in the next 1 or 2 weeks. It would take very, very bad news and factual news, i.e. something has happened, as opposed to speculating that it might or might not happen, for us to be substantially below 27.28. How is that range trade that I'm looking for expressed in volatility or supported by volatility? Well, if the market during periods of weakness does not go above this 43.05 level here, this important line, I'll know that I'm very right. I think the play is to wait for it to get to 43.05, and that should coincide with a bottom of it in S&Ps, and then it's our choice whether we sell volatility or we buy S&Ps. I think buying S&Ps might be more profitable, but I'll decide that when we get there. I certainly don't think that the market gets any higher than 43 for some time. I think it'll back off from that level and do one of these kind of things, but at a lower level, with 43 being the high, and eventually I'm looking for it to go down to 27. So to me, it's a 27-43 range. I think volatility eventually, when the market realizes that the Fed is successfully lulling us to sleep via their yield curve control, and therefore the suppression of the move index, which is the volatility in bonds, volatility in equities is going to follow a downward path, probably faster than the market can go up in S&Ps. So the trade at that level, it might be to be short of volatility and short of less S&Ps, but I will decide that when we're there. I certainly think that this 43 level is very important, and if that holds, we will know what the bottom is of the trading range in S&Ps. One final thing about US risk. Well, I told you that really the best place to short US risk would be at this kind of level, the 183 level against the TLT. We didn't get it. Basically, we got a double top, and now we are probing for the bottom. I would argue that the bottom is going to be somewhere around the 160 level. That, to me, equates to another 4% off equity, something like that. I mean, TLT is pretty much anchored, isn't it? That is the Fed's intention, to anchor it and thereby, through that, help equities and not get them below this, into this 140 level that we had at the height of the panic. So I think this 160 level, if seen, will probably be a decent level to take on more risk as opposed to less risk. And that could very well signal also a bottom in the S&Ps. I think that might coincide with, somewhere in the 2600s, high 2600s, and therefore that will be the bottom of the range. And if that coincides with that 43 level in volatility, then we have all our ducks in a row and we can go for more risk. How does that translate to the DAX? Well, apart from the DAX being a pig and being a much worse contract than in terms of return than the S&Ps, I think this chart says it all. If you have a look at this 8,700 level marked here, you'll see how that was the top in 2000, again in 2007, and then when we broke through in mid 2013, it became support, or for the higher prices that we had. We retested it, broke it very briefly on the panic. This is a weekly chart, by the way, so we broke it very briefly on the panic and then went up. To me, these are the levels. Okay, you can see that the moving averages on the weeklies are still above the market. So to me, 10,600 to 700 area is very toppy. The bottom of the range currently, I think, is around the 10,050 area, just above 10,000. And should that be broken, should that not be the bottom of the range, then this definitely will be. 8,700, I really can't see the market any lower than that for a sustained period of time. And I mean a sustained period of time. That's like a year. So but I never see any point in investing in DAX apart from certain very select periods, because the spread against the S&Ps is so clear that why fight that trend? To me, the Nikkei is a better bet than DAX. We know what the policy of the BOJ is. They keep on buying it and they will keep on buying it. The picture at the moment is not wonderful. We are below all the moving averages. This is a weekly chart, and really we do have this very good support at 18,700, which we managed to break back above. Every time that they tried to push this ball underwater, they couldn't. But there's not a lot of buying going on. It's been, if we enlarge this, we will see that basically it's done nothing for 1, 2, 3 weeks. For all this time, it's been within a closing within a 1% range of 19,500. So basically the market seems to be saying that every time it goes down, the BOJ is there buying, and really against 18,700, I think the Nikkei is a great buy, and that could be a level that we have in mind, also relative to finding a bottom in S&Ps. But all these contracts, the DAX, the Nikkei, the S&P, they're all basically saying the same thing. Control, buy the dip, establish the range. So I think all these people who are looking for retests of the new lows, I think they're wrong. I mean, certainly for in the short term, i.e. in the next 1 or 2 months, they are wrong. All these risk contracts are looking to establish a base from which they can push up again, in my opinion. One last thought, and that is the differential in volatility, as I warned you about on Twitter on Friday, I believe. It's going to be interesting next week, because finally the volatility of the States and Europe is beginning to diverge, and you can see that in the past it has always closed when it expires on the third Wednesday of the month. it's always expired around, a range between 2 and -1. And it does stupid things in the meantime, like it gets up to 10 and stuff like that. And we've had some great fun selling it up here. So I think that the market, and I just want to show you this chart, which is for K20, which is the latest one. I think it might open up somewhere around 3 to 4, and if it does that, anything above 4, between 4 and 5, we should consider selling, and I will definitely be a seller at those levels. I think the extreme here is 4, and really there's a decent possibility that that spread goes down towards negative and settles at negative. It's such a such a wonderful spread to trade. I've always made such good money on it that it'd be silly not to sell around the 4 level, looking for 0. I also want to explain why I think the volatility in the States is always going to end up being at 0 compared to Europe, or in negative territory, because the States still has some very good companies which are in positive charting territory. If you have a look at Apple, this is still a positive chart. These are all weekly charts. If you look at Microsoft, it's this is not a negative chart. If you look at Amazon, certainly not a negative chart, although it can give up another 5-7%, it's still an upward trending chart. Google, at best, at worst neutral. J&J at worst neutral. P&G at worst neutral. So what I'm saying is that I just can't see volatility in the States for the next several expiries being much higher than volatility in Europe. I think the charts in the individual stocks and the ones with the highest capitalization in the index just won't allow it. Every time you see a massive move in US volatility compared to European volatility, that is because everyone is hedging in US volatility and they drive that price higher. But eventually, maths prevails, facts prevail, sanity prevails, and it comes back towards 0. So I'm really not afraid of selling US volatility compared to V-Stock's volatility at any stage that it gets to levels around 4 or 5%. Thank you very much indeed, and tweet you on Monday.